Hello. So today I'm going to discuss with you my learnings about decentralization and segment reporting with regards to its concepts, and I'm going to apply those concepts through a sample problem later. So what I did is that I made several mind maps wherein the information that are presented in those mind maps are just a consolidation of the information or the things that I have learned from the modules provided, my notes during my first take, and some things that I have researched in the internet. So let's start with the first topic, which is decentralization in organization. So let's define what decentralization is. So according to Wikipedia, decentralization is the process by which the activities of an organization, particularly those regarding planning and decision-making, are distributed or delegated away from a central authoritative location or group. So as we all know, decentralization has its own advantages and disadvantages. So now let's proceed with its advantages. So the first one is top management is free to concentrate on strategies. And why is that? Decisions and activities with regards to day-to-day operations and the like will be done and facilitated by lower level managers. And the second advantage is lower level managers gain experience in decision making. And why? Since the decision making is distributed, lower level managers are entrusted to make decisions that concern their respective departments. And now, onto the third advantage, which is decision making authority leads to job satisfaction. And why is that? Lower level managers will have the sense of responsibility and achievement, which may boost their confidence in their jobs. And lastly, lower level decisions are often based on better information. And the reason for that is lower level managers have first-hand knowledge of the day-to-day operations or activities. Hence, they know how to handle different kinds of situations. So now, we're going to proceed on to the disadvantages of decentralization. The first one is maybe a lack of coordination among autonomous managers. And the reason for that is since managers are given freedom to govern their respective departments, the practices of one department differs from the other and may be applicable to one and not to others. And onto the second disadvantage, which is lower managers, or lower level managers rather, make decisions without seeing the big picture. And why is this considered a disadvantage? It is because since lower level managers are only deals with the activities in their respective departments, or they may make decisions based on what they only know without considering other factors. And the third disadvantage, which is lower level managers' objectives may not be those of the organization. Why? The decision made may be favorable only to the respective centers or department and not really in line with the organization. And the term applicable for this is sub-optimization. And then lastly, may be difficult to spread innovative ideas in the organization. And why? Lower level managers might only be focused on their respective departments and don't really care about the other departments. So, yeah, basically that is for decentralization in organization. Now let's proceed on to the second topic, which is responsibility accounting. So what is responsibility accounting? According to accountingtools.com, it links lower level managers' decision-making authority, which includes internal accounting and budgeting responsibility center within a company, with accountability for the outcomes of those decisions. So in responsibility accounting, it includes responsibility center, which is used in any part of an organization whose manager has control over and is accountable for costs, profit, or investments. So the responsibility centers has three types of centers. So let's go on to the first one, which is cost center, wherein the manager of the cost center has control over costs, not revenue or investment funds. The performance measurement tools used in this center is variance analysis, which includes standard cost variances and flexible budget variances. On to the next type of center, which is profit center, wherein the manager of the profit center has control over both costs and revenue. And the performance measurement tools used for this center is segment reporting and analysis, wherein comparing actual profit to targeted or budgeted profit. And lastly, investment center, wherein the manager of this center has control over costs, revenue, and investment funds. And the performance measurement tools used for this center are return on investment and residual income. So now, let's proceed on to the last or onto the third topic, which is segment reporting. In segment reporting, it includes segment, which is part or activity of an organization about which managers would like cost, revenue, or profit data. So in segment reporting, we are required to prepare segmented income statements. So here is a pro forma format for that. So we have sales less variable cost, which would give us the contribution margin. And then we're going to deduct the traceable fixed cost, which would give us the segment margin. And then we're going to deduct the common fixed cost, and then it would give us the operating income or net operating income rather. And we have another format, which is a more comprehensive one, and this one. So it includes sale less variable costs, which would give us a contribution margin, less controllable fixed costs, which would give us controllable profit margin, and from that we're going to deduct the non-controllable fixed costs, which would give us the segment margin, and lastly less common fixed costs, and then finally would give us the net operating income. So for the sample word problem, I'm going to solve exercise 11-15 segmented income statement of Wingate Company. So now we're going to solve the requirement number 1, which is preparation or preparing a contribution format income statement segmented by divisions as desired by the president. So first, let us input the pro forma income statement or the segmented income statement, wherein sales less variable expenses, which would give us the contribution margin, less traceable fixed expenses, which would give us the segment margin, less common fixed cost, which would give us the net operating income loss, or income or loss rather. And now let's add the divisions. First, going to input total, which signifies the total segmented income statement for Wingate, and then let's add the divisions: East, Central, and West. Okay, for the sales, as given in the problem, East has 250,000 sales, Central is 400,000, West is 350, and that would give us the 1 million, which is also the same as provided in the monthly contribution format income statement. And now for the variable expenses, we're just going to multiply the sales of each division by the percentage of variable expenses as given in the problem. So for East, that is 52 multiplied by 250 and so on. 30% multiplied by 400, and west, there you go. Okay, and then we're just simply going to get the sum of all of those, and then we're going to have the contribution margin for Wingate and for the three divisions, which is for Wingate, the contribution margin is 610,000. East has 120,000. Central has 280,000, and West division has 210,000. And now let's proceed to the traceable fixed expenses, wherein East has 160,000, Central has 200,000, and for West has 175,000, and that would give us a total of 535, which represents the total traceable fixed expenses for Wingate Company. So if we're going to get the sum of all of those numbers, we're going to have segment margin, wherein the segment margin for East division is negative 40,000, for Central it is 80,000, and for West it is 35,000, and for the Wingate Company as a whole, its segment it would give us a total of 75,000. And for the common fixed expenses, in order for us to get this, we just have to deduct the traceable fixed expenses from the total fixed expenses. So 625,000 less 535,000 would give us a common fixed expenses of 90,000, and then if we're just going to deduct it, we're going to get 15,000 loss, operating loss for Wingate Company. On to the second requirement, which is, as a result of a marketing study, the president believes that the sales in the West Division could be increased by 20% if monthly advertising in that division were increased by 15,000. Would you recommend the increase in advertising? Show your computations to support your answer. Okay. So in here, let us just copy the pro forma income statement segmented by divisions from the requirement number 1. Okay, there you go. So for East and Central, the sales is just the same, so 250 and 400,000, and for West, we're just going to multiply the 350,000 by 1.20 because it is said in the problem that the sales of West Division would increase by 20%. So the total of that is $1,070,000. So for the variable expenses, it's just same with East and Central, which is 130,000 for East and 120 for Central, and then for West, we're going to multiply the new sales, which is 100 or 420,000 by its percentage of sales, which is 40%, and then we're going to get 168,000. And if we're going to get the total of those variable expenses, we're going to have 418,000 variable expenses for Wingate Company. And then let's compute for the contribution margin. We're in 652,000 contribution margin is for the whole Wingate Company, and for the divisions we have, for East we have 120,000, Central 280,000, and for West 252,000. For East and Central, again, it's just the same, 160 and 200,000. But for West, we're going to add 15,000 advertising expense to its traceable fixed expenses. So we're going to get 190,000 instead, and the total of the traceable fixed expenses for Wingate Company is 550,000. Now let's just get the sum of it in order for us to get the segment margin for each divisions. So for East, it is just the same, which is negative 40,000. For Central, it's the same, 80,000. And then for West, it increased by 6. It is increased, and now its segment margin is $62,000. So for the common expenses, all we have to do again is just subtract the traceable fixed expenses from the total fixed expenses as provided in the recent monthly contribution format income statement. So that would give us 75,000, and we're going to have a new net operating income, which is 27,000. And answering the question, would you recommend the increase in advertising? Well, my answer is yes, I would recommend the increase in the advertising for the West Division, because such traceable fixed expenses increases the segment margin of West Division, and the operating income in Wingate Company increased as well, which resulted into a positive net income. Okay, now let's proceed on to the next topic under the first module, which is return on investment and residual income. So, what is return on investment? According to Investopedia, return on investment is a performance measure used to evaluate the efficiency of an investment or compare the efficiency of a number of different investments. We can compute for the return on investment using the following formulas. First, the simplified formula, which is net operating income over average operating assets. And then we could also use the expanded formula, which is ROI is equal to the quotient of net operating income over sales multiplied by the quotient of sales over average operating assets. So for the first bracket, which is net operating income over sales, is the formula for margin. Margin is the ratio of the net operating income to sales. And then for the second bracket, which is sales over average operating income, is a formula for the turnover, which is the rate at which inventory or assets of a business turn over or sell or exceed useful life. So after computing for the return on investment, the interpretation for that is the higher the return on investment, or the higher the percentage that you've computed, the more efficiently the company is using its asset base to generate sales. Now let's move on to the residual income, and its definition is residual income is the amount of leftover operating profit after paying all costs of capital used to generate the revenues. Again, it is from Investopedia. And the formula to compute for this is residual income is equal to net operating income minus the product of average operating assets multiplied by the minimum rate of return. And once we've computed the residual income, the amount represents the excess of income earned over the desired income, which is based on a minimum required rate of return. So that's that. And now on to the next topic, which is transfer pricing. So first, let's define what transfer pricing is. So transfer pricing is the price charged when one segment of a company provides goods or services to another segment of the company. So there are three primary approaches in solving for or identifying the transfer price of each department. So the first method is a negotiated transfer price. which results from the discussions between the selling and the buying divisions. So also in this approach, we get the range of acceptable transfer prices, and it is the range of transfer prices within which the profits of both divisions participating in a transfer would increase, and where lower limits is determined by the selling and the upper limit is determined by the buying division. So to compute for that, or the formula for the seller's POV, transfer price is greater than or equal to the variable cost per unit plus the quotient between the contribution margin on lost sales over the number of units transferred. And then for the buyer's POV, the transfer price is less than or equal to the cost of buying from outside supplier, and then we're going to use the second one if there is no data with regards to the cost from buying from the outside supplier. So transfer price is less than or equal to the profit to be earned per unit sold, excluding the transfer price itself. And then once we identify the transfer price, or the price at which the seller is comfortable as well as the buyer, we're going to get the range of acceptable transfer prices wherein lower limit, which is the price set by the seller, is less than or equal to the transfer price, and then transfer price is less than or equal to the upper limit, which is determined by the buyer or the buying division. And then the second approach is the variable or full absorption cost, wherein the transfer price consists of the variable cost per unit plus the fixed cost per unit. And then onto the last approach, which is at market price, which is designed for situations in where there is an outside market for the transferred product or service, or product or service is sold in its present form to outside customers. And on to the last topic, which is service department charges. And for this, I've made a summary table. So here we have the timing. In the service department charges, it is important to know the timing when it comes to the problem solving. And the timing for this topic includes at the beginning of the year and at the end of the year. So we're going to know, if we're given a problem, we're going to know if the timing is at the beginning of the year or at the end of the year, if we're going to look onto the purpose of the allocation of the service department charges. So if the purpose is for planning or determining the sales price, then the timing would be at the beginning of the year. However, if the purpose shown in the problem is performance measurement, then the timing of the problem is at the end of the year. Knowing the timing of the problem is very important because the treatment for the variable cost allocation depends on the timing. If the timing in the problem is at the beginning of the year, then the treatment for the variable cost allocation would be budgeted variable cost multiplied by the budgeted activity. However, if the timing is at the end of the year, the variable cost allocation would be budgeted variable cost per unit multiplied by the actual activity. And then, regardless of the timing of the problem, the fixed cost would be same for both at the beginning of the year and at the end of the year, wherein the fixed cost allocation is computed by total budgeted fixed cost multiplied by the allocation rate. And take note, when it comes to the allocation rate, the percentage must be based on either the peak period capacity or the long run average capacity. And the main takeaway for this topic is that budgeted cost of a service department should be charged to the operating departments. And why is that? It's because it ensures that service departments remain solely responsible before explaining any differences between their actual and budgeted costs. And if service department could base their charges on actual cost, operating departments would be unfairly held accountable for cost overruns in the service department. So now let's try to solve a problem for service department charges. So we have here, Creator Corporation has two operating divisions, an Atlantic division and a Pacific division. The company's logistics department services both divisions. The variable costs of the logistics department are budgeted at $266,400. The logistics department's fixed costs are budgeted at $399,600 for the year. The fixed costs of the logistics department are based on the peak period demand. So here we have the numbers. For Atlantic Division, its percentage of peak period capacity required is 25%, and for Pacific it is 75%. And for the budgeted shipments, Atlantic has 1,600, and for Pacific Division we have 5,800. At the end of the year, actual logistics department variable costs totaled $308,040, and fixed costs totaled $418,680. The Atlantic Division had a total of 2,600 shipments, and the Pacific Division had a total of 5,600 shipments for the year. For this problem, we are required to know or to solve how much is the actual logistics department cost should not be charged to the operating divisions at the end of the year. First, let us identify the timing of the problem, because it is, as I have said earlier, it is important to know the timing because the treatment of the variable cost allocation. So, said here in the problem, for performance evaluation, this means that the timing of the problem is at year end. Okay, so now let's try to solve that on Excel. So now let's try to solve the problem. So first, let's input the headings. Just Atlantic Division, one for Pacific, the total, and then one for fixed cost, variable cost, and its total. So first, we're going to solve first for the service department charges that should be charged against the operating departments. So for that, for the fixed cost, we're going to multiply the budgeted fixed cost, budgeted fixed cost, which is 399,600 multiplied by Atlantic Division's percentage of peak period capacity, which is 25%, and then we're going to do the same for Pacific, which is 399,600 multiplied by 75%, and we're going to get these numbers. So for Atlantic, it is 99,900,000, and for Pacific Division, it is 299,700. That would give us the total, the same in the given, it is 399,600. Okay, for the variable costs, first we're going to solve for the variable cost per unit because it is not given in the problem. So to solve for that, we're going to divide the budgeted variable costs by the total budgeted shipments. We're going to get the budgeted variable cost per unit. So let's add the values. Budgeted variable costs, which is 266,400 divided by total of the budgeted shipments provided given in the problem, which is 7,400. Then going to get this one. There we go. Okay, let's move that up. There, going to get $36 per unit. So now we'll be able to allocate the budgeted variable costs. So $36. Well, since the timing of the problem is at the end of the year, we're going to use the actual shipments for this. So again, $36, or the budgeted variable cost per unit, multiply the actual activity. For Atlantic, it is 2,600, and then for Pacific, it is $36 multiplied by 5,600, should give us these numbers, and then just going to get the sum of those. There. Oops. Okay. So here are the numbers. So the total actual the total actual cost to be allocated to fix the apartment, specifically under Atlantic division, it should be 193,500, and then for Pacific it is 501,300. So now we're going to answer the question. So how much is the actual logistics department cost should not be charged to the operating divisions at the end of the year? So to solve this, I'm going to get we're going to compare the actual and budgeted cost. For fixed costs, the actual is 418,680, and then for the budgeted allocated service department charges, and that is 399,600, and then for variable cost, the actual is this one, $308,040, and for budgeted it is this one, 295,200. And then let's get the difference. What am I even doing? Okay. So the amount of the actual costs that shouldn't be charged to the operating departments is 31,920. Now let's solve a problem about return on investment and residual income. So the problem reads, the following information pertains to Bingo Concrete. Sales revenue is $1,500,000. Gross margin is $600,000 rather. Income is $90,000. Invested capital is $450,000. The company's imputed interest rate is 8%. So the requirements for this problem are the capital turnover, sales margin, return on investment, and residual income. So now let's solve it on Excel. Okay, now let's try to answer this problem. So I've already inputted all of the necessary data in the Excel. So first, let's try to solve for the capital turnover, or simply the turnover. So based on our expanded formula that I have shown in the previous slides, turnover is computed as sales divided by average operating assets. I'll give you turnover. Okay, based on the problem, its sales revenue or sales is $1,500,000. Now we're going to divide that by the average operating assets, or base in this problem it is the invested capital, which is for $450,000. So the turnover is, sorry about that. Again, so the turnover is 3.33. So we're going to put X here. Okay, so next for the sales margin. So the formula for that, based on the expanded formula that I have shown earlier, is net operating income divided by sales, which will give us the sales margin. So the net operating income in this problem is 90,000, and the sales, of course, is 1,500,000, and our sales margin is 0.06 or 6%. So for sales margin, it is expressed as a percentage. However, turnover is not expressed as a percentage. So now we'll be able to compute for the return on investment. So we could use the simplified formula, which is margin multiplied by the turnover, should give us ROI. So we could just simply get into numbers. So here the margin, as we have computed, it is 6%, and the turnover is 3.33 times. So for the ROI, that would give us 0.20 or 20%, and ROI is expressed as a percentage. And then lastly, we have the residual income. So the formula for the residual income is net operating income less the product of average operating assets divided by the imputed interest, give us total, and then residual income. So now let's input all the numbers. So for the net operating income, that is 90,000. Average operating assets, that's $450,000. And for the imputed interest rate, well, based on the problem, that is 8%. That would give us this one. Let me just, okay. Now, since we've got we'll be able to compute for the residual income. So residual income is computed by 90,000 less 36,000, and our residual income is 54,000. So that is for our problem. So now let's solve a problem about transfer pricing. So the problem reads, Bronx Corporation's Gauge Division manufactures and sells product number 24, which is used in refrigeration systems. Per unit variable manufacturing and selling costs amount to $20 and $5 respectively. The division can sell this item to external domestic customers for $36, or alternatively, transfer the product to the company's refrigeration division. Refrigeration is currently purchasing a similar unit from Taiwan for $33. Assume use of general transfer pricing rule. So the requirements are, first, if Gauge had excess capacity, what transfer price would the division's management set? And if Gauge had no excess capacity, what transfer price would the division's management set? Okay, now let's solve it on Excel. So now I have already inputted all of the necessary data that is needed in the problem. So let's answer the first requirement, which is if Gauge had excess capacity, what transfer price would the division's management set? So it is said in the requirement, Gauge had excess capacity, and in this problem, Gauge is the selling division. So based on the problem that the formula that I have shown earlier, the transfer price that would be set would be the variable cost, and the variable cost consists of the following: the per unit variable cost, which is $20, and then the per unit selling cost, which is $5. So the transfer price would be there $25. And for the second requirement, which is if Gauge had no excess capacity, what transfer price would the division's management set? So based on the formula that I have presented earlier, which is variable cost plus the quotient between the margin on lost sales divided by the number of units transferred, give us the transfer price for the selling division. And in here, in this bracket, the one word that we're computing is the lost margin per unit. So to solve this, again, we're going to compute for the variable cost, which is per unit variable cost, which is $20, the per unit selling cost, which is $5. That is our variable cost per unit, which is 25. And then going to add the margin on lost sales per unit. Since we don't have any data with regards to the number of units transferred, we're just going to use the per unit prices. So in here, we have the selling price and the variable costs. So for the selling price, that is $36, and then we're going to less the per unit variable cost is 20 into per unit selling cost, which is 5, to come up with the margin lost per unit sold, which is $11. So if we're going to add these two together, we're going to get our transfer price, which is 11 plus 25 and that would be $36. So that is for the transfer pricing.